BHP wants to buy Anglo American. The all-share offer values Anglo at £31.1 billion. BHP says it's willing to offer just over £25 a share to Anglo investors. It will also pay £4.86 a share for Anglo American Platinum shares and £3.40 a share for Kumba Iron Ore shares. The proposition entails Anglo demerging its holdings in both Amplats and Kumba. The components of the proposal are mutually dependent. If the transaction goes through, the combined entity will have a leading portfolio of large, low-cost, long-life Tier 1 assets, and those will be focused on iron ore, metallurgical coal, potash and copper. Anglo says it is evaluating the proposal with the assistance of its advisors. The news has caused a run in Anglo's share price, with the company ending the day stronger, up 18.9%. Clicks has bagged profit growth during its first half. The health and beauty retailer's headline earnings per share rose 13% during the period. The groups attributed the performance to its resilience in overcoming mounting headwinds in the trading environment. It gained market share across the retail, health and beauty categories, grew private label products, strengthened margins and generated robust cash flows. An interim dividend of R2.10 has been declared. That reflects an increase of 13.5%. Looking ahead, Clicks expects full-year diluted headline earnings per share to rise between 10 and 15%. Canal Plus has once again upped its stake in Multichoice. The French media group now owns 41.6% of Africa's largest pay TV company. Canal Plus has been aggressively buying up shares for almost 4 years, to the point that it recently triggered a mandatory offer for the group. The latest development is that the two firms have entered into a cooperation agreement on this. Solidarity has lashed out at steel sector bosses who want to base wage increases on minimum rates of pay and not on actual wages. The trade union says this will disadvantage skilled and experienced artisans. Unions recently met industry bosses for a second round of wage talks at the Metal and Engineering Industries Bargaining Council, and have called on employer bodies to table a meaningful wage offer in the steel and engineering sector, where the lowest paid employee earns just over 59 Rand per hour. The final round of talks is set to be held on the 8th of May. Producer price inflation has ticked up. The latest print from Stats SA shows a 4.6% rise in March from 4.5% previously. That outcome is slightly above consensus expectations. The main contributors to that pickup in PPI inflation were food products, beverages and tobacco products. In international news, global automakers and EV startups unveiled new models and concept cars at China's largest auto show, with a focus on the nation's transformation into a major market and production base for digitally connected new energy vehicles. Let's take a look at this report for more.
China's largest auto show opened in Beijing on Thursday, and the biggest names showed off their latest electric vehicles, underlining that in the world's largest auto market, all electric cars are the future and there's no looking back. Automakers are set to unveil 117 new models, up from 93 at last year's show in Shanghai. And overall, 278 new energy vehicles will go on display, which is 7 more than last year. The show comes after sales of such cars hit a milestone in early April. Data showed they accounted for over half of cars sold in China. Shipments have been getting a boost from a year-long price war that has sapped profit margins, as automakers strive to keep up by announcing newer, cheaper models and promotions. Crowds flooded the booths of Chinese manufacturers such as BYD and industry newcomer, phone maker Xiaomi. Its CEO said locked-in orders for the sporty SU7 sedan, its first car, had hit over 75,700, and that buyers included owners of cars from brands like BMW and Audi. Foreign automakers have been scrambling to reset their China strategies and catch up with the electric shift. At the show, they touted plans to invest more in local production and research, with Japan's Nissan and Mazda unveiling cars tailored for Chinese drivers.
And the EU has recently weighed a ban of TikTok. These considerations come after the US Congress voted to ban the app from their country. Here's our reporter Anatin Devu with more.
Well, that's right, Zinati. TikTok has been one of the fastest growing social media platforms over the past few years. It, of course, faced controversy from the very start, and it seems like that train is still rolling. This is on the back of the EU discussing a possible ban. With us now, though, to provide the latest is Lars Halter from Deutsche Welle, who is currently standing by in Berlin. Lars, what's behind the latest discussions in Brussels?
Yeah, thanks for having me. Well, this is first and foremost about a new service TikTok has recently launched. It's called TikTok Lite, and within the EU, it's only available in France and Spain. It is not available here in Germany, which is one reason why I haven't looked at it personally. The other reason being that I'm probably not part of the target audience here. That would be younger people, teenagers especially, it seems minors. And that is exactly where the problem lies. TikTok Lite is offering those kids points for watching lots of clips and for inviting friends. The more clips you watch, the more points you get. And these virtual points can actually be exchanged for real money to be spent on Amazon or other sites. It seems pretty clear that this incentive program is likely to be addictive for kids. And that's the EU's biggest concern here. The EU's Digital Services Act bans so-called dark patterns, which are manipulative ways to keep users on platforms longer. And TikTok Lite is running afoul of that. The Commission in Brussels has asked TikTok owner ByteDance to run a risk assessment and respond to some questions. Now, ByteDance has done that. It has just filed a risk assessment report, but that obviously won't solve the problem at hand.
Lars, with the EU and Chinese trading tensions, I think we're all interested in knowing whether this has anything to do with TikTok being a Chinese-owned service.
Not really, but there's a second case being debated in Brussels, and that has to do with the company behind TikTok being Chinese. According to a study, the EU Commission has seen TikTok allegedly tends to feature and promote pro-Beijing content on its app. Also, ByteDance, again, that's the owner of TikTok, is accused of not having provided a sufficient level of data privacy and has thus broken EU law. Now, that law, again, would be that Data Security Act I've just mentioned. And that one comes with huge fines. The EU can levy fines of up to 6% of a company's annual revenue. And in the case of ByteDance, that would be billions.
Well, Lars, we can't help but notice that the EU's banning consideration comes a day after the US Congress voted to ban the app in the US. So what's the latest there?
Yes, the US Congress has just passed a bill that would ban TikTok if the US business isn't sold to a US company within a year. And now it's getting interesting because a sale of TikTok's US service within a year is very unlikely. It really can't be done in such a short time. And we'll also be talking about a deal worth tens of billions of dollars. So who would even be able to afford that? Maybe Google or Meta, but those companies would be out based on antitrust concerns for sure. Also, the US Congress wants the TikTok US business to be completely isolated from ByteDance, and that is also impossible because the app depends on the algorithms owned by ByteDance. So we're essentially looking at a ban after a year or so, and that is quite a big deal. Half of Americans support it. The other half pretty much uses TikTok, and also it should be clear that China would strike back. Beijing has already banned WhatsApp and Threads from Chinese app stores. So what we're seeing here now is yet another escalation in an ongoing trade or trust war between the US and China.
Well, let's leave it there for now. Thank you so much for those updates. That was DW's Lars Halter.